Oh boy. Oh, I missed the first few minutes of this recording. Okay, moving on. So the first phase is, during the Tax Cuts and Jobs Act. Yeah, maybe that's going to get extended. Maybe we'll see another 4 years or something in between. But then also, there's this phase whereby, you're forced to start taking RMDs and you're not forced to take Social Security, but you should, because it doesn't get, your benefits don't grow anymore once you get past 70. But these are, I combine them because they happen around the same time, but these represent a couple more phases whereby the structure of your taxes, or the factors that impact your taxes, are going to change. But then there's also, if you're married, you could have the passing of the first spouse. And that means you're no longer going to be filing jointly. Married filing jointly is no longer going to apply after that year. So when you have just one person filing individually, your tax brackets compress and you have about half the tax capacity before you hit the higher rates. So that can impact you as well. And then you have the passing of the second spouse. And now I know a lot of you are thinking, oh, well, what do I care at that point? Well, I like to plan even just a bit beyond that, and thinking about the money that ends up getting passed on to heirs or charities, because that's going to be applicable as well. If you hand down a bunch of IRA pre-tax money, then your kids or whoever inherits that is going to have to pay the taxes on that. And maybe they are in higher tax brackets than you were in your retirement. So that's just another detail that I like to tend to and optimize. Okay, so there's also those other taxes and costs that I mentioned. So IRMAA, we've mentioned a few times now, but that overlays all of this discussion. And that depends on the levels of income in each and every year, albeit with a 2-year lag. But there's also net investment income tax. Technically, I could have drawn that a little bit wider. It applies all the time, but that can apply to certain people with a significant amount of investment income. The bottom line is we want to coordinate all these factors that we can control in order to minimize the taxes and the related costs, IRMAA, throughout your entire retirement, to maximize the amount of money that ends up in your pocket. So the way I look at this is, there is a fair amount of complexity. We don't just want to avoid the pitfalls. We actually want to use the rules to our advantage. And I liken this to a Rubik's Cube. If anybody's ever done a Rubik's Cube, you have to, me, when I was first trying it, you do one side at a time. And then every time you do one side, it bumbles up the other sides. Well, to really do the Rubik's Cube, you can read the book, and you really need to coordinate all 6 sides at once. And that's really, I think, a good analogy for tax planning. There's a lot of different dimensions, and it's important to coordinate them all together in order to maximize your results. And I'm just going to insert, I have a video. I'm not going to make you watch it, but my son, he tends to do the Rubik's Cube in less than a minute. And I videoed that, and I promised him I'm going to insert that video somewhere on my website at some point and generate some income for him, which he will then put into his Roth IRA. Yes, my son has a Roth IRA. So that's just hinting at some more angles for tax planning. Okay, so now finally, that's a bit of background about the tax code. Now let's look into the tax strategies to minimize our taxes. All right. The first thing, I sometimes get challenged, John, I say we can choose the type of tax we pay. Now, I don't know how many people in here have heard of the form, IRS form UPD 101. Now, I see some of you, if you come to my seminars now, please don't reply to that. There's a little bit of a trap here. So the basic idea is that form UPD 101 looks like this, a tax election form. So it's got a few boxes. You just pick which tax do you want to pay. Do you want to pay no tax, capital gains tax, long-term capital gains, or ordinary income? Now, obviously, some of you are probably looking at me a little bit funny right now. But the reason you haven't seen this form is because UPD stands for unicorns and pixie dust. That form does not exist. However, I will say I have a close second place solution to being able to select the types of taxes we pay on certain amounts of your assets or income. And that is what this asset location is all about. So this strategy, asset location, is not the same as asset allocation. I think most of you are going to be familiar with asset allocation. That's just how much money we put into stocks, bonds, and other types of investments. The classical illustration is a pie chart like you see here. So now, once we determine what kind of portfolio we want to have, what sort of composition of stocks, bonds, and other investments, we can then decide where to put it. So asset location answers the question, if we have an IRA, a Roth, and a taxable account, the question is, where do we put the stocks? Where do we put the bonds? Where do we put the other types of investments? Remember, different types of accounts have different types of tax attributes or treatment, as do different types of investments. So maybe we can use some flexibility to our advantage, and we can. Let me give you an example, a rather extreme example. Peter Thiel, maybe controversial figure as he is, but he's a very successful investor, and he's invested in companies that have grown by multiples of 1,000 more. PayPal, Facebook, Palantir, all these things he invested at when they were very small, and then now they've grown into multi-billion, 100 billion, trillion-dollar companies. Maybe not trillion in here, but the basic idea is, let's say he finds the next great investment, and he's going to invest in it. The question is, where should he place that investment? What dollars should he use to purchase that investment? So the answer is the Roth account. And that's just because if he picks another big winner, by putting it into the Roth account, all of the growth and all of these distributions are going to be tax-free. Now, I should mention one other thing belatedly here. Apologies if it's relevant, but I'm talking about taxes within your estate. Some of you are going to have, this first world problem of so much money that when it spills over to the next generation or whatever, the estate taxes are going to apply. GST exemptions aren't enough and so forth. I'm ignoring all of that. Funnily enough, Thiel will get himself into a pickle with estate taxes with this particular kind of planning, but that's a non-issue here. The point is, he's a pretty smart guy, and he has put this money into Roth accounts where it's grown tax-free and will be distributed tax-free, so much that he has earned this reputation as Lord of the Roths. Okay, but the basic idea here, though, is the question of asset location. When we have different types of investments, where do we want to put them? So I'm going to explain a bit of some of the intuition around that. So the first asset I'm going to think about is our growth-oriented stock allocations. We typically invest in stocks for growth. That's our long-term growth play. And the question is, well, where do we put the stocks? Now, we already know if we have Roth accounts, we want our high growth assets there. But let's for a moment pretend we don't have any Roth accounts. Let's think about the future taxation of the growth. Okay, so we have a current account value. It's going to grow, and that growth is going to be taxed. The question is, if we put it in an IRA, how is it going to get taxed? If we put the stocks in our IRA and they grow from there, all that future growth from here on to whenever the money is pulled out, all that future growth is eventually going to be taxed as ordinary income. Not good, because ordinary income is higher than our capital gains. Well, let's think if instead we put that money in our taxable account. How is the growth going to be taxed there? Ultimately, it's going to be taxed as capital gains. But maybe if we're lucky and the tax code stays the same, it might actually get a step up in basis. That means that all the growth we had in the stock, when we pass, it goes on to our heirs, perhaps even our spouse, with a stepped up basis. So all in all, it's better to have higher growth assets, well, first in Roth accounts, but next in our taxable accounts. Because eventually all the growth in IRAs is taxed as ordinary income. But if we have in our taxable accounts, it's eventually going to be taxed as capital gains, if any tax at all. So the logic there is to locate our stocks in taxable accounts. I'm again ignoring the Roths where we know they go first. Next, bit of logic. Now let's consider the taxes on interest. I have a typo up there. Consider the taxes on interest. So the example I'm thinking of is CDs, money markets, maybe bonds, what have you. But whenever we think about the interest on these bonds and money markets and CDs, if we put that in an IRA, what's the tax going to be on that interest? Well, guess what? The IRA gives you a shield, right? You haven't seen any taxes from your 401k or IRA or any of your pre-tax accounts, not until you distribute them. So the ongoing interest payments that maybe get reinvested, what have you, you don't see any taxes from that when they're sitting in pre-tax accounts. On the other hand, if we had them in our taxable accounts, which I know many of you do, it's just the way most people are structured. They end up with a bunch of money in their bank account and they just buy some CDs or money markets. And that money, remember what I said earlier, bond interest is taxed as ordinary income. That includes your CDs and your bank money markets. So that ordinary income, you know where it goes? It stacks right on top of the rest of your ordinary income you have from any other sources, pension, social security, job, what have you. So that's about the worst place you could hold your fixed income investments is your taxable account. So the bottom idea here is that the logic is that we want to, we already know, we said locate the stocks and taxable accounts, but locate the bonds and the pre-tax accounts. And just to be clear, if we think about putting the bonds in the pre-tax accounts, bonds are not our big growth assets. So we're going to worry less about growing that tax liability, that tax bill that's attached to our pre-tax money. All right, this is probably a good point to pause. Allocation, to what level? Oh, yeah, great question. I'll answer this very quickly, but this discussion is more about taxes and investments. But somebody asked, to what level do I distinguish between emerging, international, small, large, value, growth, etc.? By and large, when I run it through the planning software, I kind of gobble it all up and look at it as just stocks. But I will tell you that a lot of times, if you haven't seen my Humpty Dumpty cartoon, a lot of times what I see is people basically take the whole stock market, they throw it on the ground, break it into a bunch of pieces, tape it together, call it a managed portfolio, and charge you 1%. And the basic idea, though, there is that, you know, I do these portfolio audits, a free service I offer. I'll mention that at the end. But the idea, though, is that when I look in these portfolios, I see small caps, mid caps, large caps, all these stocks. I say, well, what are you doing here? You're spinning your wheels to go nowhere. You add those all up, you get the whole market back. And the whole market funds generally are cheaper than these individual funds. So don't let your advisor pretend he's doing investment work when he's actually holding up a variety of stocks and bonds that really just add back up to the total market. All right, pardon that aside. So asset location. Okay, so some of you might be asking, okay, I get it, Aaron, but how impactful is this? Well, I'm here to tell you asset location can be very impactful. So I want to take my time to explain what's in this slide. What we're looking at here is I'm going to compare planning strategies where we use an optimized asset location strategy and we don't use it. And I'm going to look at a handful or 4 different scenarios. Hopefully, you might identify with one of those scenarios and be able to draw some parallels to your own situation. So the first scenario is a couple that has $250,000 in savings. They have Social Security benefits of $1,500 and $500, and they spend approximately $3,000 a month. Now, in the footnote, I basically assume that they have half of that money is going to be in stocks, half of that money is going to be in bonds. I've also assumed that half of their money is in an IRA and half is in a taxable account. No Roth here. Roth only makes things better, by the way. So if I look at a couple that's in this situation and I optimize their asset location versus using the same portfolio across all accounts, it's going to save them about $13,000 in taxes. Now that's over the course of a lifetime. Now, That might not seem like a big number, but let's look at people in slightly higher brackets. Couple number 2 has $500,000 in savings, $2,000 and $1,000 Social Security benefits, and they spend about $5,000 a month. How much is asset location, an optimized asset location, going to save them? About $83,000 in taxes over the course of their retirement. You know, if you're going to live, you know, say retirement is 20, 25 years, you know, that equates to, you know, a couple thousand, you know, several $1,000s a year. Let's look at somebody with $1 million in assets, slightly higher Social Security benefits, slightly higher spending level. Here's where it really starts to make an impact. By not using asset location, just treating all accounts the same, allocating them similarly versus an optimized asset location, the tax savings from minimizing the tax on the growth of pre-tax accounts and minimizing all that ordinary income tax of stocks and bonds and CDs held in taxable accounts is multiple hundreds of thousands of dollars. Now to finish this up, I'm going to add one more example. Now it's the same couple with the same savings and benefits, except for they spend more money. And what happens here, I just like to show the trends to say, oh, the numbers go down, but how is that? Well, the idea is they're spending more money. And what that means is the size of their portfolio decreases through retirement. So the benefits apply to a smaller pool of money. But still, I don't know anybody in here that if I set $13,000 on my desk or on the table between us and tell them to take it, they're not going to take it. So anyway, asset location is can be a very impactful tax saving strategy. This applies to your taxable accounts, your pre-tax accounts, your Roth accounts, but also if you have other financial products like annuities, life insurance, or even trusts, different types of trusts. We want to optimize the way the assets are allocated across all of those vehicles. And one thing I'm going to say about asset location, by and large, it is very easy to implement. So that's the good news. Hopefully everybody can go home and optimize their asset location tomorrow. Okay, now I'm going to reuse this sort of output. I've grayed out the Social Security benefits there, but I left them in just for the sake of completeness. But it's important to optimize your Social Security as well to not only maximize benefits, but also it can be part of your tax strategy as well. All right. So let's see. Any other comments? No comments. Hopefully, sometimes I say when I'm presenting, if there's no questions, I don't know if I'm presenting so wonderfully that you couldn't possibly have a question because I've explained everything so clearly and thoroughly, or I've explained things so poorly that you can't even put together a question based on what I've said. I hope it's the former. All right, moving on. The next tax strategy we're going to discuss is Roth conversions. So Roth conversion is basically a way of taking your pre-tax money, your traditional retirement accounts, again, that's your IRAs, 401ks, 403bs, 457s, things like that, paying the taxes and turning those into post-tax money, but still retaining all of the benefits, the tax shielding. So even the interest and the growth, all that kind of dividends, interest, portfolio rebalancing is not going to be taxed. But now, even when you take the money out of that account, the taxes have already been paid. Roth accounts give you tax-free growth and tax-free distributions, assuming the tax code does not change. So now we have tax-free funds for the rest of our life if we can build up a Roth account. And I will tell you, one very important facet that I just don't hear anybody talking about this. Well, I hear it mentioned, but not quantified. Roth accounts do not have RMDs. So that means all that benefit of tax deferral and compounding does not have to get chiseled away or cut down via RMDs while you're still around. In fact, your heirs will probably have another 10 years of tax-free growth and distribution on the other end. So Roth is a very powerful way to be able to control some of your taxes. Now, we got to be careful. We don't want to overdo it. I have seen many cases, people come into me to check their math and I say, oop, you've converted a whole lot of Roth, maybe more than you needed to. But by and large, the error is on the other direction. People haven't converted enough, but there's a lot of cases where it doesn't apply. It just doesn't help people. So if I look at a Roth conversion plan, if I look at what it looks like in terms of future taxes, this is basically the future taxes for an individual or couple, that it's front loaded. We've paid a lot of taxes in the front. And the idea there is that we've bought our way into lower tax brackets. But we've not just bought our way into lower tax brackets, but you remember that interdependency. Having lower taxes further out in retirement, that also means less capital gains tax potentially, less taxes on Social Security, less taxes, or less IRMAA, less net investment income tax, a whole bunch of other goodies. So Roth conversion is not a single dimensional issue of how much or what is the tax rate I pay on that money. I'm going to, you might have seen in my email, I have a video in the works where I'm going to explain all the different factors one by one that are relevant to Roth conversions. Okay, so keep an eye out for that. All right, got another comment. Yay. If I convert to Roth while in retirement, do I have to wait 5 years to access any of the money from that account? Very, very good question. So thank you, Doug. The basic idea here is if you already have a Roth account, even $1, well, first, let me say there's a 5-year time clock from when you start a Roth account to when you can take money out of it. But that's not on a dollar per dollar basis. That's on that clock is set to the timing of the Roth account itself. If you set up a Roth account and funded it with $1, 10 years ago, your clock is already past the 5-year deadline. So that's a really good question. Thanks for asking. So there are, I guess, more generally, that could be construed as a negative facet of using Roths. I can't touch that money for 5 years. At the same time, I would say, well, you're putting it in there to get tax-free growth and distributions, and you want to take advantage of all that. Why take it out within 5 years is another question. But still, very fair point. Thank you. Now, let's take a step back and think about Roth logic. Let's look at the big picture of our lifetime. In the early years, we're earning money. You probably start out at a slow salary. Maybe you earn a few more bucks through the years. At some point, we have more experience and we start to earn more money. Then at some point, hopefully, we retire. And retirement is, there's sometimes a period within retirement that I call the golden period for tax planning, because you basically can fall off a cliff of tax brackets whereby, hey, you don't have those big paychecks coming in, so you're in really low tax brackets, and it can be really fertile ground for Roth conversions. But then what pops up later, don't forget, Social Security might pop up later, or those R&Ds going to be forced to take money out of there. So we got a little bit of a puzzle here. Where are the right places to do Roth conversions? So the way I think about this just intuitively is that I want to distribute my pre-tax money here. I want to spread it out as evenly as possible throughout my retirement. So the pre-tax money just sort of fills in this space. And if I do it that way to where it's not lumpy, I'm keeping my head below different tax brackets. And that's sort of the idea, not to pop up into higher tax brackets. Well, that in retirement sort of sets an equilibrium. Michael Kitces, probably top financial planner in the country. He talks about retirement tax equilibrium. Maybe I'm abusing or mixing up the jargon, but the basic idea is eventually you're going to kind of put yourself in a situation where you're going to have a bare minimum level of taxes you're going to pay in retirement. And if you then extend that backwards, you see my red line, it goes all the way back to the early years. So obviously we don't have crystal balls and we can't go back in time. But if we think about this, well, hey, when I was earning when I was in these high earnings brackets, that was a great time to make pre-tax contributions, putting money into 401ks and IRAs, because I reduce, I'm in those higher tax brackets and I'm reducing the income that's exposed to those higher tax brackets. And it's going to instead hopefully fall below that red equilibrium line in retirement. Well, what's another angle? Let's go back even further. What about our kids, or grandkids when they start to enter the workforce and they're probably earning as little as they'll ever earn? Maybe that's a great time to pay the taxes on that money because they're probably never going to see a lower tax bracket after that period. Anyhow, this is the basic idea of how I think about Roth conversions and how to use them wisely, excuse me. So now let's go back here and start looking at our hypothetical couples and look at the Roth savings. Well, again, for the first couple, Roth conversions didn't make any sense whatsoever. They were falling below the radar of Roth conversions or tax brackets that warranted Roth conversions later in retirement, so it didn't matter. Our second couple, same figures as before. Well, they saved $14,000. Okay, still it's not money I would leave on the table, but it might not knock your socks off. Let's take the $1 million couple here, spending $6,000 a month. Here we're starting to move the dial. Roth conversions optimized for this couple are going to save in excess of $100,000 throughout their retirement. Now, mind you, I don't have a crystal ball and this is all estimated, but these are real numbers. I'm not nothing contrived here. It's just optimized or not optimized for Roth conversions. And then our last couple, they actually have a smaller benefit and the logic is the same because they're actually spending down more of their money. Remember, these have the same amount of money and benefits, but they're spending more. And that means you have less portfolio taxes that are relevant. The portfolio is getting smaller, getting spent down, and hence the benefits are smaller. So Roth conversions can definitely move the dial, as can asset location. Now, I will just kind of pat myself on the back here and highlight some of the research I've written. This was what, six years ago, about the math behind Roth conversions. I do feel like a lot of people miss it. They just look solely at the tax bracket and they miss the lack of RMDs. They miss the other IRMAA, Social Security, capital gains, interdependencies, and that can make all the difference in many cases. By the way, I guess this research was published on a website called AP Viewpoint. That's a website or a forum for professional advisors. And I have, I guess, 22,000. This is probably 2 years old now, but I have more than 20,000 professional followers listen to what I say on that forum. So I do have a decent idea about what I'm talking about here. All right, enough patting myself on the back. Withdrawal strategies. So our third and last strategy to discuss tonight is going to be withdrawal strategies. And the question here is, what is a withdrawal strategy to begin with? Well, some people think about, a withdrawal rate. And that question is, how much can I pull out of my portfolio? Can I pull out 4% a year? Can I pull out 5%, 6%? That's a withdrawal rate, how much I'm withdrawing from my entire portfolio. But withdrawal strategy is more a question of where you pull it out from and when. Remember that tax torpedo animation a few minutes ago? That was money pulled out of an IRA. Maybe it would be better to pull money when you're in that situation out of a Roth IRA if it exists, or a taxable account to minimize some of those interdependency tax compounding. So the purpose of the withdrawal strategy is just to maximize, to duck and dodge all the different tax brackets and arrows that are being kind of shot at you. So, the question is, do you pull money out of your taxable account, your IRA or your Roth IRA at any given time? It depends on a lot of factors. And in many instances, I don't know if it's most, but it'll be very common to be pulling from multiple accounts in any given year. So that just kind of adds to the complexity. And it can change year from year. So you remember the tax torpedo and how that more than quadrupled the tax rate on that money? That's the sort of thing we're looking to avoid. You've heard me talk about a lot of different taxes and fees and costs, whether it's federal income tax on ordinary income, capital gains, Social Security, IRMAA, Medicare adjustments, net investment income, all these different things. I liken this as, if you ever seen any of those movies where they're trying to steal something from a museum or a jewelry store and they have this laser security, That's really what I feel like, or I think a lot of people feel like when it comes to retirement planning. I generally think the tax code is unfair, but at the same time, it's job security for people like me. But I just think it is unnecessarily and unfairly complicated. So let's think about these withdrawal strategies. The most common withdrawal strategy is what we call conventional wisdom. So let me pop it up there again. We withdraw first from taxable brokerage accounts. Then we go to our pre-tax money or tax deferred accounts. And lastly, we wait to pull anything out of those golden goose Roth accounts until we have to. So there's some intuition here. It kind of makes sense. People feel comfortable with this. And in fact, this unfortunately is just often, maybe even more often than not, the optimal withdrawal strategy. So what that means is a lot of people pursuing the conventional strategy are pursuing a very suboptimal withdrawal strategy. They're falling into the tax torpedo, capital gains bump zone, all those little pitfalls I highlighted earlier. But what's worse is the conventional withdrawal strategy is the default assumption in most financial planning software that's out there. It's sort of embarrassing. And more generally, the financial planning software that's out there, it takes your Social Security decision, your Roth conversions, your withdrawal strategy. It takes those notions as inputs. They're not outputs that are getting optimized. They are inputs into the software. So all over the place out there, there's financial planners and individuals, kind of holding the proverbial finger to the wind and guessing what's the right Roth strategy, what's the right withdrawal strategy, what's the right Social Security strategy. But, with all this interdependency, it's important to optimize these together. So now, all right, got another question here. Spending I did not run out of money. Mind you, somebody made an observation that the $1 million company spending $8,000 a month, or about $100,000 a year, $96,000 a year. That part of that comes from probably half of that or more is covered by their Social Security benefits. So it's kind of like spending $4,000 a month on $1 million portfolio, which that still strikes me as a little bit high. But what am I missing there? I had the I'll go back if it's okay. I'm going to take that aside because it's not popping right into my brain there. But that's a fair point. All right. So conventional wisdom. Many retirees are pursuing this, even though it's suboptimal. But when you start to look at, you remember all those phases I was pointing out earlier, the Tax Cuts and Jobs Act, when you're retired, when you're still working, when you take RMDs, when you take Social Security, all this kind of stuff. All these different phases add to the complication of the withdrawal strategy. So, and the charts that I'm going to show you down here is, I'm just going to show you a few different strategies based on hypothetical account situations or client situations, but sometimes it's non-conventional or the opposite. So this is, if you look here, it says non-conventional, but excuse me. Oh, no, it has tax deferred first here. In this case, these people's or this person's withdrawal strategy was to pull money out of the tax deferred, the pre-tax money first, not taxable. Another case looked like this. Going taxable, tax deferred Roth. Well, that's the conventional wisdom. Taxable, tax deferred Roth. In other cases, it's mixed, taken from different accounts at any one given time. You see the mixed colors in a lot of those different years there. Lastly, it can be against mixed, manages to different tax brackets. So I'm making a distinction that is not evident from the pictures, but the strategy you choose for withdrawal strategies is very impactful. So let me get into that summary slide again. Make sure, did I have another question sneak in there? Okay, Aaron has to leave the seminar. No, I'm kidding. I'm sorry. That one of you that was signed up for me. I apologize. This is lasting longer than anticipated. One of the things I noticed, somebody pointed out, I did not advertise the time, and I do apologize for that. So I'm just about done here. So that's the good news. So the withdrawal strategy impact, let's just jump into it. It's the same couples as before. Here, couple one, remember the smaller benefits on the other strategies. Here we have a significantly larger benefit. Let's go into couple number two. Boom, that's a significantly larger benefit than either the location or the Roth conversions. Couple number 3, big numbers here, rivaling asset location. And again, couple number 4, still big. And the reason it's big is because even when the portfolio is winding down, it matters how you pull the money. You're actually pulling more money out, making the withdrawal strategy even more impactful. And just to kind of close the circle here, let's look at the total taxes paid by these couples. That is not a typo. The total taxes for that first couple with an optimized retirement, optimizing Social Security, asset location, Roth, and withdrawal, $150. Couple number 2, about $4,000. Again, total taxes paid throughout retirement. Now, we move into the higher brackets. Taxes are going to be a bit higher up here. Move into the higher one. They get lower here. But again, the reason they're lower is because they're chiseling away their portfolio, that common trend we saw before. Now, given the time is kind of short, I put this in here. I'm going to skip over the charitable giving slides. Just be mindful. I will say one thing here. There's multiple ways to give away money if you're charitably inclined, and I respect that. The most powerful way are qualified charitable distributions, QCDs, giving money directly from your IRA. Other ways, donor advised funds and donating appreciate assets are, I would say, a distant second place. There's more complicated structures down at the bottom there, but I think these structures, by and large, are promulgated or pushed by the attorneys, estate planning attorneys, and some of the accountants. I think they're novel and they sound very intuitive when you're sitting there figuring out how to donate money to a particular cause. But 9 times out of 10, in my opinion, we can figure out a more tax efficient way to do it if you're sort of in a normal situation with pre-tax money. Now, parting thoughts. Before I go into parting thoughts, let's see. Thanks. Okay. You're welcome, Bill. Parting thoughts. I'm going to give a little bit more information about myself or my business. So hold on to your wallets. It's a little bit of a sales pitch, but at the same time, I will tell you, some people have told me that this section, the part about advisors and brokers coming up, was more impactful for them, more important for them than anything else. And I could give you specific situations or examples if you like, but let me just move on through here. We know this tax puzzle. We have earned income. We eventually retire. You saw this picture before. We have a certain amount of income we need. Maybe it's flat. Maybe this is an inflation adjusted number, whatever. But the idea is we have these accounts to pull from, and we have to fill in this puzzle down below. So we have to figure out how to do this puzzle and try to minimize taxes when we have all these different tax brackets and arrows and thresholds and things to deal with. So it is somewhat complicated. Remember the 3 layers of tax planning? I'm only talking about the middle one, tax efficiency. There's also the economics of income. How do we structure our income? If you have Social Security decisions, pension decisions, annuity decisions, how we manage our portfolio, it's all relevant. Number 2 is the tax efficiency we just discussed. And the 3rd layer, this is my approach to financial planning, is to look at risk management and robustness. When I build a financial plan, I want it to be robust. I don't want it to fall apart if some reasonable situation pans out. So, suffice it to say, retirement and tax planning, retirement planning in general is complicated with a lot of interdependencies. There's a lot of different factors, and obviously the stakes are going to be high. I'm naturally biased, but I say you should probably seek the help with somebody that knows what they're doing here, a professional. So when you look for a professional, it's very important to think about trust and competence. But you have to be really, really careful here. There are a lot of different labels: financial advisor, financial planner, broker, investment planner, investment, any combination. I paid a cartoonist to draw up that little slot machine down below. But the thing is, titles and labels are confusing, but what ultimately matters is licensing. And at the highest level, the most important thing is whether you are dealing with an advisor who has to be 100% fiduciary, or you're dealing with a broker. They operate to a lower standard. suitability standard. And that just means they can sell you things even when they know there's better products for you, as long as it's reasonably suitable. It's not horribly inappropriate. Advisors, again, 100% fiduciary standard. What complicates this further, unfortunately, is that there's overlap between these. And I have not drawn this to scale. I'll point that out in a second. But when you have people that are registered as both advisors and brokers, they are dually registered, you don't know what standard of care. It depends on the documents you sign on each individual account. You don't know what transparency you get. Advisors have to have plain English, legible, or understandable transparency in their documentation. Brokers, I mean, it can be on small print on page 34. They just operate on a lower standard of care. Custody of assets. Advisors like myself, I do not custody assets. I cannot take your money and run off and retire myself. Brokers, on the other hand, do have physical direct access to your money. So when I'm talking about duly registered advisors, you're like, well, who is that? Those are most of the advisors that work at the mega banks. You know the names. I'm not going to highlight them here, but they're quote unquote advisors. I think these are basically wolves in sheep's clothing, because they hold themselves out as advisors and fiduciaries and CFPs and all of this, and then they pull all sorts of stunts and purchasing funds, annuities, life insurance, and products that are not the best for your situation. So to put a little bit of context around this, I'm saying that the overlap here is not drawn to scale. There are only, of all the financial professionals out there, only 9% are pure advisors, unaffiliated with brokerages. So chances are about 1 out of 10, if you're speaking to a financial professional, that they're going to be a broker or duly registered broker. And say, well, okay, but they're a good guy. Yes, but the numbers say otherwise, at least on average. There are some good people working in these companies. Nicole Boyce and some other professors, they've done research on this. Duly registered advisors have the highest rates of violations, penalties, arbitrations, lawsuits, everything you name it. They take the cake. So whoops, sorry. It's in the news as well, although that news article basically highlights her article and some others. So it's very important to understand who you're dealing with. Brokerage firms, brokers, one thing that I see over and over again is that people have these high fee funds. Why would you be in these high fee funds? Well, my broker got it for me. Well, I'm paying my broker to pick my portfolio. Why is he picking high fee funds? Well, he's picking those funds because those funds pay his firm or him a kickback. It's called revenue sharing agreements. Barron's is about the only publication that is on the case here. And I applaud them for their efforts and trying to add transparency. But this is a massive conflict of interest. You pay somebody to build a portfolio from you, and then they put products in that give them kickbacks or their firm's kickbacks. I'd call it double dipping, but a conflict of interest at very least. So now I'm going on a little bit long here, so let me just be quick on this one. I think it's very good you need to be able to trust somebody, but then you have to be able to assess competence. I would say that's actually harder. You can look up licensing and see if somebody's registered as a broker or an advisor or both. When it comes to competence, it's a little bit tougher. But in general, I classify financial professionals as those that just do portfolio only planning. If you call it planning, your financial plan is basically just a pie chart, on the front of your statement somewhere. It certainly doesn't involve all the different decisions or strategies we discussed today. So they're not looking at these other Social Security decisions, Roth conversion, so forth. There are financial planners that do focus on the multiple dimensions here. They even run market simulations and generate some pretty pictures and output. But what you really want, what I think is really important, is to run an optimization. And I can tell you, this is where you're going to get the best results. So when I know most people are over here. That's why people attend my seminars. They just, if I have a Social Security seminar and you come there, it's because if you have an advisor, they're not helping you with this. I've landed some of my biggest clients through Social Security seminars because their current advisors just don't discuss these things. Well, there's fewer people over here. But what I will tell you, there are even fewer people doing the optimization. And you say, hey, how do you know that? Well, I develop my own optimizations, but the only financial planning software out there that does this, which I also use, the name of it, it's called Income Solver, but its market share is less than 1%. Whereas the big financial planning softwares, eMoney, Money Guide Pro, Right Capital, those are the mega companies that get all the market share. And quite frankly, they are easier to use and produce better pictures. I'm happy to go through the work through the tougher interfaces and less aesthetic output to produce better financial plans. So where does that leave us? What do? We can leave the room or leave the webinar and do nothing. You can do things yourself, just kind of hope you get things right. Or, you can enlist the help of a professional. And I'm raising my hand here, whether you can see it or not. So I want to let everybody know that I think a lot of people like to do a lot of things themselves, but just need somebody to dot some I's, cross some T's, run some big picture optimizations or financial plans. I can do that. That's this graphic on the right. I can do things as one-off. The majority of my clients, or I don't know if it's a majority anymore, but a lot of my clients I'm their personal CFO. If it has a dollar sign involved, I'm involved. I'm doing everything. They're not lifting a finger to the extent that I can shield some burden or work from them. This is typically billed as a percentage of assets, but if the numbers get very large, the percentage of a large number can be a large number. I can operate on a fixed fee. That we just have to discuss. It has to work for me and it has to work for you. So I offer everybody a free consultation. I think I give a good balance of trust and competence. And I do appreciate everybody for taking the time to watch this. I encourage you to take me up on the free consultation. At the same time, I'm going to email you after this, soon after we finish here. And I'm also sticking around for questions, Q&A session. But I'm going to send you an email with some feedback questions that I would really appreciate, even if we never talk again with no free consultation, nothing else. I really just appreciate your honest, genuine feedback. So with that, I'm just going to say thank you and open it up to Q&A. Thank you. Munis and taxable to offset income. Tax bracket earners. Yes, somebody here is asking about using municipal bonds and taxable accounts. So when you use municipal bonds, number one, you are paying a tax. You're just paying it implicitly through the lower rates that the municipal bond typically offers. There are occasions where it's a no-brainer, but higher rates than other bonds. But in general, you're paying an implicit tax. Okay, so I need to read the rest of this question. Issues arise when the options to invest in your employer qualified plan for certain asset classes are weak, true. And then you select the best within the plan and imagine others on the outside, taxable accounts. Yes. So number one, I do not often use municipal bonds. And the reason is it goes back to asset location. If I'm going to own bonds, I'm going to try to own them in pre-tax accounts or possibly annuities if somebody has an annuity. That's just the concept of asset location, putting my quote unquote boring bonds in those pre-tax accounts where the income isn't taxable anyway, and they don't grow my pre-tax money tax liability too much. But issues arise when options to invest in your employer qualified plan for certain asset classes are weak. Yeah. In general, when I'm stuck, helping somebody out make some 401k, 403b, or whatever qualified plan, I'm looking for the cheapest options, and I'm typically hunting or fishing around the bond options. If you have a really bad plan, let me know. I know an attorney who sues, who takes 401k plan sponsors to task. But it's unfortunate. 401k plans, 403bs, a lot of these plans, I liken them to movie theaters that kind of once they get you stuck in there, the popcorn and the Coca-Cola are overpriced. It's sort of the same with a lot of 401k plans. 401k, some company says, oh man, I've grown my company. I need to get a 401k plan now. Somebody walks in, offers a 401k plan. They say, oh yeah, that sounds great. How much is it going to cost? And they say it's free. Well, that should raise an eyebrow, because that just means they're going to be picking the pockets of the plan participants for years to come. So I hope that answers your question, but if you have more to it, feel free to email me directly. Charitable giving portion, lump sum, or is that a lump sum to give after retirement? Let me fly back there just so I can have the pictures to refer to. And that was here. Okay, number one, I say the most powerful way is to give money is going to be your qualified charitable distributions directly from the IRA. You have to wait until the year in which you're, I think, 70 and a half years old. I don't know half years round why they use those numbers. They're moving the RMDs further out, but anyway, you got to wait. You have to be old enough to do QCDs. So maybe those won't apply, or maybe they don't apply anyway. Well, let's say we're in a situation where we can't do it from our IRA. We're going to look into our portfolio. We're going to try to find some appreciated assets. And in general, don't forget, we still have very generous standard deductions. Could be $15,000, $30,000 a year, depending upon you're single, married, maybe higher if you're older, which most of my clients are. But the basic idea there is you try to do it in a lump sum in 1 year to get a big deduction, a big itemized deduction in that year. And then you still have retained your standard deduction in the following years. So you've only sacrificed one standard deduction in order to do the itemized deduction. So to answer your question, in general, yes, it is done as a lump sum. The word that I usually see, and I mean, I think I use it too. I do have a research article on this, or an article on my website about charitable giving. But the word I commonly see with this type of strategy is bunching, gift bunching, doing it all in 1 year. Donor advised funds, this middle class DAF. One of the nice things about donor advised funds is that you can donate appreciated assets or just money directly into there in a lump sum in a given year. But then you don't have to give the money to the charities. It's kind of a middle ground, a holding place, a holding spot for that money. And then you can give it away, the next year, 10 years from now, 20 years from now. The downside to donor advised funds that I don't like, I do not charge my advisor fees on donor advised funds because I like to encourage philanthropy on one hand, but on the other hand, most donor advised funds, even my beloved Vanguard, Charles Schwab, Fidelities of the world, I think they charge too high of fees there. So that's just my 2 cents. Good question though, and thanks for getting me back to this slide. Since we have time and a few people still on here, good few people. We still got 40 people here. I'm surprised I haven't put anybody to sleep yet. More questions? How do I get paid? Oh, how do I get paid? Some people write me checks. Some people use Zelle to my business account, to be clear. Some people, when I manage accounts, Schwab will automatically calculate and deduct the fees. It's all very transparent. I have to send an invoice, and Schwab puts it on the statements in those quarterly months where my fees show up. I am, probably to my own detriment, incredibly transparent around everything. Charitable giving portions. How do I do the charitable giving or lump sum? So it depends on your custodian, but it's usually as simple as an asset transfer. You open an account, say a donor advised fund, and you request your custodian. They'll have a form, a digital application or form to transfer those assets in kind. So they literally, well, I say literally, they take the shares. I like to think of physical shares. I'm motioning here, but I don't know that I'm visible. They take the physical shares and kind of move them into the donor advised fund. I think I'm answering the right question. Now, I'll tell you, it's that time of year where I'm starting to revisit my clients' financial planning, figure out, what is our strategy towards the end of the year, making sure we get all our RMDs taken care of. Are we going to do any Roth conversions? We review investment performance and things like that. And I have a lot of things to say about investments. I've never done a seminar on investments or income. I've done annuities before, seminar on annuities. I feel like I'm genuinely best placed. I've seen them from all sides, working with the insurance companies and these kind of newfangled, complicated products and helping them manage risk, to seeing them on the street. And full disclosure, I am licensed for life insurance and annuities, but so that business runs by commission. They do have some new products that you can manage account within an annuity. And so instead of a commission, it's like a managed account. But 9 times out of 10, or maybe 9 out of 100 that I've seen, that works out worse than the commission. But I, no matter what I do, I still have to be a fiduciary and be very transparent and find people the product that makes the most sense for them. How do I calculate a Roth conversion? A lot of moving parts. If I may be so rude as to say, wait until my Roth video article comes out. I'm actually going to have a Roth worksheet included in that article that you can print out and kind of work through your calculations. I'm going to tell you it's tedious. It can be tedious and it can be messy. It just depends really how your assets, your investments are structured. I run into some people where they're just lickety-click clean, and I run into others and I'm like, oh, there's income from here, a trust, a this, a that, annuity, a pension, a social, and oh, I got this other account I forgot about and it's paying some interest or some dividends. All of these factors, all of these calculations, we're trying to look and tally up. Where are we within our tax brackets, late in the year? Well, then we have to extrapolate and say, hey, well, what else is going to happen in the rest of November and December? Where are we going to be? And what capacity does that leave us? And just because the question came up, Roth conversions, at least in terms of how I approach them, typically have 2 thresholds I target. One, will call for targeting a federal income tax bracket, like the 24% tax bracket. Some will call for 32, 35, or just unlimited. But in other cases, instead of targeting federal tax brackets, who else shows up in these calculations or in this analysis is MAGI, or is a modified adjusted gross income, because of the IRMAA, the Medicare surcharge. So that's another one. If we have a Roth conversion and the IRMAA becomes relevant, or if the level is close to the federal tax bracket, they're calculated 2 different ways. The ordinary income for the federal income tax bracket, but your MAGI doesn't have any deductions, no standard or itemized deductions, but it includes capital gains and all your tax exempt interest. It's just these really different dimensions. But the idea, though, is if there's a MAGI or a IRMAA threshold nearby, maybe we need to back up the Roth conversion, do a little bit less. I'll tell you, in some of the cases I work on, Roth conversions, I mean, the case is just so strong. It's so powerful. It has such a big impact that, we mow right over IRMAA. We just say, oh, fine. It's just, a collateral damage to get the Roths done and to get the benefit there. But everybody's situation is different. So I can't get specific on that for obvious reasons. Another question, if I can find my mouse. All right. Are you picking individual assets or using ETFs for client portfolios? 90% of the time I am using exchange traded funds and mutual funds. And taxable accounts, I strongly prefer using exchange traded funds. If you haven't seen my video or my article on exchange traded funds and their tax blessing, then I recommend watching that. But in general, it puts you in control of your taxes. In general, you're not going to get a lot of taxes that are spun off from the investments inside of exchange traded funds or ETFs. Mutual funds, on the other hand, I mean, there's case studies. Sequoia's famous mutual fund when Valiant went bad. There's just horrible. I don't know if you own mutual funds, you probably already know you're getting these capital gains just handed to you. You know, it's like, hey, you can even get capital gains distributions in years when the mutual fund itself is down. How's that for salt in the wound? You know, you watch your mutual fund go down in a given year and somehow they're sending some taxes your way. I do manage individual stock portfolios for some people, very rare. 9 times out of 10, I can find an ETF that is close enough to what I need to achieve. But in some cases, a specific investment thesis or purpose mandate. In other cases, we want greater granularity for tax loss harvesting and taxable accounts. And that's just, you know, if you have, say you have 5 different mutual funds that hold 100, 200, 500 stocks each. If the market goes up, I tell you, all of those funds are going to be up. You have no tax loss harvesting opportunities. But if you own all the stocks individually, you rip off the vehicles, the wrappers, the funds that you're holding, and you just hold all those stocks individually, surely somebody out of those hundreds of stocks is going to be down, and we can harvest losses. That's quite a technical road or rabbit hole to go down. So I'm just going to leave it there. But short answer is mostly exchange traded funds, but also some mutual funds. Do you use the newish individual ETFs where you pick the assets yourself, or have thoughts on them? Pick assets yourself. All right. If you're talking about the very large scale, is that the 351 programs, where you can contribute assets into an ETF, but you're not supposed to have discretion over what gets done within a fund. I'm not 100%. Please feel free to clarify here or hit me afterward if I'm missing the point here. There's a lot of different new ETFs being issued out there. A lot of historical or traditional mutual funds are converting their mutual fund structure to ETFs. You can see it, JP Morgan, just all the big names, because they're realizing it's just more tax efficient. Sorry if I didn't answer that question, but feel free to explain it again or whatever, or chase me down later. Am I going to do another presentation? Yeah, I plan to do some more presentations. I'm probably going to shut down on the seminars, webinars. I could probably squeeze in a webinar. I just don't know. One, I like to know that there's demand for it, but number two, it's just getting very busy planning time of the year. Austin has been very good in helping me out with this, but you know, that New York Times article I mentioned earlier that's the biggest since I've left Wall Street. That's the biggest media attention I've gotten, and it's been really good for business. So we're pretty busy around here, and year end is traditionally seasonally the busiest time. So then in January and February, I teach a class up at University of Florida. It's just 1 day a week, but 1 day a week for me is losing 20% of my time. It's actually a little bit more because of the commute. And it adds to my workload. I got to grade some papers. I got to make sure the content is up to date. So January and February, I'm not doing seminars or presentations either. Probably March. Although I will say this webinar, despite my hiccup with advising about the timing in the beginning, meaning how long it'll be, and clicking the record button, I'm going to be in the doghouse for that. But this has been pretty easy for me to organize, pretty easy and pretty cost efficient, that I could see webinars. I'm reaching a larger audience. It's cheaper, easier logistically. It's very positive. How do I judge this stuff? I love teaching. I love doing educational things like that. At the same time, I do measure the results. You know, what kind of business do I get out of these? Kind of the cause and effect. I do, you know, interesting. I have clients from pro bono to billionaire. I have a very eclectic, wide range of clients. I do not do everything for money. So, you know, if I really get it down to a well-oiled machine, I could probably do more webinars, do webinars more frequently than historically I've done seminars. Oh, personalized indexing. Oh, I'm sorry. So end of life. I see what you're saying. So the question about these ETFs or the end of life personalized indexing. So personalized indexing is basically managing a rules-based portfolio inside of your account and where you can define the rules. I think the benefits are far oversold. This tax loss harvesting, I think it gives way to the tax efficiency of ETFs at any given time. And one of the things is if you're going to tax loss harvest, run a personalized index portfolio, unless there's more money coming into that portfolio cash flow wise, let alone, please don't be chiseling away from this portfolio. You're going to end up in a portfolio of very highly appreciated assets at some point with no opportunity to harvest losses and only opportunities to trigger significant gains. In general, I'm not a fan of that strategy unless somebody is significantly older where getting locked into that portfolio is less of a concern because they'll get the step up in basis. I think it's more of a marketing play from Wall Street. Yeah, I see what you're saying now. Good question. And by the way, indexation was quantitative equity. One of the teams I built and ran over at Barclays before I got into financial planning is just another name for indexation. You're welcome. I find the webinar great. I control I find the webinar great too. I can control the temperature of the room and the snacks I eat. Yes, thank you. Yeah, it's easier for me too. I'm sitting here. Definitely easier logistically, that's for sure. But I also, I like meeting people, getting to know people, seeing people, shaking hands, talking. I like that element too. I don't want to be confined to my office only. All right, let me just do a little time check. We are at 7:45. I am going to be here till 8. So until, how did we get more attendees? We went up again. I'm so silly. Okay, I got it. Thanks. I was reading the number of questions. It was an increasing number. Okay. So yeah, let me know if you have any more questions before I sign off here. I'm getting a good stream of thank yous, so I'm guessing that some people are signing off. Let me just see where my screen is. Participants. Yep, it's slowly ratcheting down there. Going down. Squeeze it in, squeeze it in. Any last questions? Okay. Oh, yep. Oh, super fun time. Wow, this is your idea of fun. We're gonna get along. Yeah, okay, thank you. I appreciate that. All right, well, I'm gonna circulate after I get off here the feedback form. I mentioned on there, if you don't want to give the feedback directly, if it's constructive criticism or whatever, and maybe even harsh, I've had some. Give it to me straight, and if you feel awkward giving it to me straight, put it in an envelope, type it, no signature, and drop it in a post office in the town next door. All right. Oh, thank you. Irony alert. Did I miss something? Was that you? No. All right. All right. I'm hanging out here. If anybody oh, nope, got more. 10Q. The whole life insurance. With whole life insurance, how do you most often use them when they have significant cash value? I have some strong opinions about life insurance. One, that it's oversold. So I encounter a lot of people with life insurance and annuities, legacy products. What's important is to understand how we want to use life insurance. I might use life insurance for, say, younger people, disability insurance, to protect against the loss of income. That might be true for somebody with a significant pension that's tied to their lifespan only. They don't want to leave their spouse hanging if they were to pass. So maybe a life insurance policy makes sense there. But it's very, very important to understand why you own the life insurance. And there's two purposes in my experience. Number one is for the purpose of insurance. to hedge a risk. If somebody has a large pension and it's tied to their name, then maybe want to buy life insurance to kind of hedge that if they were to pass away early. What if, but the other use is, as often marketed and often mismarketed, is a tax-free piggy bank or an alternative to a Roth. We just have to be very clear about what we need to get out of it. I don't recommend a lot of life insurance, but I can certainly use it, or optimize the way we use it if it's there. So the question was, how do you most often use them when they have significant cash value? Two ways. I will treat it if the borrow rates, if the terms of the policy are good, then we'll stick with it. We'll maintain it if it needs to be maintained, and we'll use it like the Roth piggy bank. Alternatively, I say we don't need it. Why do we have it? Maybe somebody was thinking about buying an annuity or something like that. We'll move it. You can move a life insurance cash value into an annuity. It loses some of the tax-free nature, but it still gets some annuity type tax benefits. I don't like to do that. The reason I don't like to do that too much is because the taxation of annuities in taxable accounts is very quirky. Everybody talks about the benefits of exclusion ratios and things of the sort, but there's a bit of a tax time bomb embedded in there. When you hold an annuity in a taxable account long enough, up into their actuarial expected time lifespan, all the cost basis has been spent or has been paid to you. You've run out of cost basis. The very next year or 2 years, maybe there's a middle year where it's half-half, 100% of the income coming from that annuity is taxable from there on out. I like symmetry and planning when it comes to things, that stretch out over your entire lifetime, not handing yourself, your older self, a tax grenade. Yeah, I'm sorry if I don't have a specific answer, but I generally, the Roth piggy bank, cash it out sometimes, move it into a new, more competitive product. Market rates are higher now than they were for a lot of products that people bought 5-10 years ago. We can just move it tax-free, exchange into a new product and lock in higher rates. That's an option, but it really just depends on the broader situation. That was probably a longer answer than was warranted. Sorry. I think somebody raised a hand, and I don't know how to handle that. Can I click on it? There's a question down here. Don't see it. Nope, don't see it. All right, last call. 7:53. All right, I don't want to have a standoff here, so I'm going to leave it here with the promise that if you come up with questions in the next 7 minutes or even tonight, just email it to me. I'll do my best to get back to you by the end of the week. All right, thanks again, everybody. Really appreciate it. Look forward to seeing you, hearing from you, and have a great evening.